Thank you for joining us for our webinar this month. My name is Matt Hilland. I'm a financial planner here at Arnold and Moat Wealth Management, and our topic this month is on direct indexing. If you haven't heard of this, don't worry, we'll get into specifics, but it wouldn't surprise me if you've started to see this around. It's becoming very popular. Or it's being pitched very aggressively out there. It's expected to have about $1 trillion in assets in this strategy in the next year or so. And just to kind of start from ground zero here, what is direct indexing? And so, just most simply, instead of owning a fund like an ETF or a mutual fund, you're owning a very long list of individual stocks. And so, just for example, if you want to invest in the S&P 500, the most common way and the easiest way to do that now is to buy an S&P 500 index fund. So, SPY is one of the big funds out there. Vanguard, this is your VOO ETF there. This has been very, very popular, very low cost, and the way that, quite honestly, we prefer clients to be invested in the S&P 500. But direct indexing now is doing something very different. Instead of seeing that one holding in your account, you're going to see potentially up to 500 individual stocks in your account now. And so you're buying Nvidia, Microsoft, Apple, and the 497 other companies there. And so, the big question is, why is this a thing? ETFs have become more and more popular, and now this kind of feels like a step backwards, right? We're going back to individual stock investing. Well, one reason is just technology. There's programs out there that make managing a portfolio of 500 stocks much easier. There's kind of automatic trading that can be done, automatic rebalancing. That's making this easier to manage. Zero commission trading has also opened this up too. You're not paying $20 to buy every single stock anymore. That's made this doable. And then fractional shares is something that's made this much easier to push towards non-really high net worth investors like it was in the past. And so all that's coming together to yeah, really have direct indexing being out there for the vast majority of investors today if they want to. And it's going to come with a really good sales pitch, highlighting two main benefits of doing this. For customization, I'm not going to talk a lot about this. Really, what this is getting towards is just more active management. They kind of bill it as you can set up your portfolio how you want it, but the minute you are starting to take out investments that you don't think are going to do as well, you're being an active investor. We know, why index investing is becoming so popular or has become so popular, why it works so well is that you own the market. And so this customization is billed as a benefit. I'm not going to talk a lot about the difference between active and passive investing in this webinar. We have another webinar on that if you want to see more details on that. The big benefit that we're going to talk about in much more detail is that tax alpha and why these direct indexing companies are claiming that they can, give you so much more, so much better tax adjusted returns, something along that line. And the whole basis of this tax alpha argument is that by owning all these individual stocks, instead of just one single ETF, there's going to be more opportunities to tax loss harvest. This is selling stocks, selling investments at a loss so you can get a tax deduction on that loss. And this is a chart from Vanguard here showing the line here is kind of the return of the S&P 500. And so just for example, in 2023, that returned, I think, about 24 or 25%. But the bars here are showing the percent of holdings in the S&P 500 that had a positive return and a negative return. And so the argument with direct indexing is that if you own all the individual stocks, now even though the market is up, you'll have some companies here that lost value. You'll be able to sell those, tax loss harvest, get that tax deduction, and still experience that growth in the market, but get some added deductions there. And so why tax loss harvesting is beneficial is for a couple reasons. One, you can use losses that you capture to offset other gains. And so if you have, a mutual fund that kicks off capital gains, you can do tax loss harvesting from other holdings here to offset that. So you're not, there's no tax impact from that. If you're selling other shares somewhere else, you can do tax loss harvesting to offset any gains you might have incurred. There's also a little benefit here where excess losses can also offset a small amount of income. It's capped at $3,000, and so you can't, recognize a $50,000 loss on a stock and get a $50,000 income tax deduction. But you can use up to 3,000, and any excess amount can be carried forward. And so there's just a table here showing what the value of that $3,000 deduction is, depending on the tax bracket. And you can see it's nothing earth-shattering. It's not probably not going to change anyone's life here to save, $700 a year, but it is a benefit that's out there, and part of the calculation for why being able to tax loss harvest more often can be valuable. And I should say one other note here too. This can only be done in taxable brokerage accounts. And so you cannot tax loss harvest in your 401k, your IRAs, or your Roth IRAs. And so know that we're only talking about those non-retirement savings accounts. But one thing that gets lost in this kind of obsession about tax loss harvesting is that tax loss harvesting is not a free lunch where you just get this deduction and that's the end of the story. Tax loss harvesting is just a tax deferral. And so to show that as an example, I just wanted to consider a very basic example here of buying a stock at $50 and it goes up and down. You don't do anything for the years it's going up and down. Eventually that stock hits $100 a share. You sell and you have $50 in capital gains. The pretty basic scenario, right? Hopefully pretty clear. Now let's look at what happens when you are tax loss harvesting. And so that same stock that was $50 a share in its ups and downs at one point drops down to $25. You sell that stock there, you recognize a $25 loss, that gives you a $25 tax deduction. Uh, but then you eventually want to rebuy the security, right? You owned it at one point thinking it would do well. You rebuy that security at 25 and it eventually gets back to that $100 price tag. But the difference now is that because you rebought this, you sold and rebought at $25 a share, you don't have $50 in gains anymore. Now you have 75. And so although you did get that tax deduction early on, that $25 tax deduction, it's really just a deferral here because now you're paying $25 more in taxes whenever you go to sell this investment. This is something that gets lost a lot when talking about tax loss harvesting, is not realizing that you're lowering the basis on your investment, and eventually when the time comes for you to sell that investment, that additional gain now is going to have to be realized. And then just to put some numbers on the scenario, how much tax loss harvesting can you really get from direct indexing? This is a chart from a direct index provider, FREC is the name, and they have a couple good white papers and studies out there on direct indexing. And what this chart here is showing, the y-axis is the percent of your portfolio that you can tax loss harvest, and then the x-axis here is the years that go by. And so right now I'm just highlighting this first year in direct indexing, and they are kind of suggesting that you could tax loss harvest about 15% of the value of your portfolio in the first year you get on their platform. This is an estimate, of course, so it's always going to depend on the market, but this is kind of what they put out there as some projections. So if you're investing $100,000 into Frex direct indexing platform, they're saying approximately $15,000 in losses is what you're going to be able to capture in that first year. But there's a catch with this that also kind of gets glossed over as you start thinking this. People see that projection of, hey, I'm going to get $15,000 in deductions every year. But that doesn't last because as stocks go up, you lose the ability to be able to tax loss harvest. And so every year, the amount of tax loss harvesting you can do with direct indexing declines. And so again, this is just filling out the rest of their chart here. And what you're seeing is that over time, the amount of tax loss harvesting you can do declines and gets very close to just 1 or 2% of your portfolio. And what's worse is that as you tax loss harvest here, what you're doing is, of course, selling the losers. The winners are still running. You're not touching those ever. And at the end, after a few years, you're stuck with a portfolio of just stocks that have very high gains. And that leads to, again, kind of a long-term disadvantage of doing this direct indexing, or at least potentially a disadvantage. And that's there's a lot of unrealized gains that are going to get embedded in this. And so when you need to sell, you are not going to have the opportunity to find some higher cost basis investments. There's going to be a lot more built up taxes in this investment now. And so this is just another chart just trying to show that over time, what you're going to see is the tax loss harvest options declining, and then the unrealized gains, this is what's going to be taxed when you sell, is going to dramatically increase. And over time, it's going to leave you with a portfolio that's going to be more expensive on a tax basis to sell and very difficult to unwind without recognizing that higher tax liability. There's one other issue here before we get into some specific examples of the numbers behind direct indexing, and that's, of course, that there are fees to do this. Nobody's going to do this for you for free, and those fees can be somewhat substantial. There are very high cost options out there. I kind of put as an average between about 20 and 40 basis points. I believe Vanguard charges 20 basis points, so that's why that's there. I think Fidelity charges a little bit on the higher side of this range, but that's what you should expect to pay if you want to do this. There are some options out there for some lower costs. You'll see that, but it tends to only be in a single index. Like the S&P 500 you can invest in for this fee, but you probably don't want all your money in the S&P 500, right? So as soon as you start using some small cap or something like that, you're going to get a portfolio that's in, around this average fee here. And so know that that's another big equation that's happening here that, if you have a very big taxable brokerage account portfolio, you're adding a percent-based fee to be able to direct index. And that's going to be a big offset to any potential benefit that's out there. And we'll look at that in just a sec. And so just to put some real numbers in front of you on the benefit or potentially lack of benefit of doing this, I have an example here. And what I'm looking at here laid out some assumptions here. The big things to keep in mind is that we're factoring in some kind of long-term capital gains tax rate. I am assuming the 15% capital gains bracket here because that tends to be where the vast majority of investors are in. If you're married and have taxable income under about $600,000, you're probably in this scenario here. And then also in the 24% income tax bracket. And so, again, you're probably familiar with capital gains are taxed at a more advantage rate than income. This is going to come into play because, again, tax loss harvesting can offset some amount of income. Um, Again, you pay fees here, so I'm assuming you're paying on the low end of that direct indexing fee of 20 basis points. All investments have some sort of fee, so I'm saying you're going to pay 5 basis points for a very basic index fund portfolio. And so effectively, in our example, direct indexing is going to cost you 15 basis points. Just to have some dollar amount, we're going to say there's $250,000 invested. That portfolio grows at 10%. And then this tax loss harvesting schedule is from that FREC graph there showing how in the first couple of years you can get a large amount of tax loss harvesting and then it slowly declines. And so we're saying in the first year that you direct index, you're going to have tax loss harvest of 15% of the portfolio. And so I'm going to have a couple tables here. I know it's a lot of numbers, but I wanted to really be able to give you a concrete number on the potential value, potential costs of doing this strategy. And so all this table is trying to show is year by year the amount of tax loss harvesting you're able to do. So that's just this second column here multiplied by the portfolio value. You're going to be able to get some kind of income tax deduction. Again, just $3,000 deduction. We assume that this household's in the 24% income tax bracket. So that is a real benefit to you to be able to get about $700 a year. The value of the capital gains deduction then. So this is what's left over from the tax loss harvest amount after, the $3,000. And so, for example, this is 34,500 times 15% is what this number is here. And then of course you have some negatives to this. There's a cost to do this, and all that kind of comes as some net benefit for you. And so you'll see here over 3 years, you can get a good amount of tax deductions. You're getting some income tax deductions. And what you're going to see this kind of very nice net benefit number. This is what's advertised out there as the benefit of direct indexing, right? Who doesn't want $11,670 in kind of bonus money out there, right? But as you can imagine here, there's something that this is not really factoring in, and that's eventually you're going to have to sell these investments, right? This is funding your retirement. You're going to have to sell this one way at one time. And now you're going to see paying back a lot of this benefit. Because what happens is, as you're tax loss harvesting, you're lowering the cost basis of your original investment. And that means when you go to sell, you're going to have a higher amount of gains. Remember that example we showed early on, that $50 stock that went down to 25, then went up to 100. We're looking at that same type of example here, just with some larger numbers. And so while you are getting that $11,000 in benefit, when the time comes to sell, you're going to have a much bigger tax bill. You're going to have almost a $20,000 tax bill to sell out of this portfolio. If you never did any direct indexing, never did any tax loss harvesting, put that 250,000 and it grew at the same rate, your tax bill at the end of this would be $7,800 or so. And, again, so with direct indexing, you kind of got $11,000 over 3 years. That was good, but now you're paying $19,000 once you have to sell. And ultimately, when you kind of factor in paying 19,000 but getting 11,000 compared to kind of no benefit but just paying 7,800, these two scenarios converge to be very, very similar kind of net um, net proceeds from your investments. There is not this huge $11,000 bonus that's sitting out there like the direct indexing kind of sales pitches lead you to believe. And so here I wanted to look at a few of the fine prints, I guess, that are in some of the marketing pitches for these. And the first one is exactly what we were just kind of showing. A lot of the numbers are not assuming that you have to sell this investment at any point. And so you'll see a chart of something like this. Again, this is coming from Freck here. They're going to show some chart on how if you direct indexed, you ultimately have a lot more money. What this is not showing is that to sell this direct index investment, you're going to pay a lot more in taxes than some of these other strategies here that they're comparing to. And ultimately, this ends up being kind of similar to if you were comparing like a pre-tax retirement account balance to a Roth. And of course, if you have $1 million in pre-tax, that's more than if you had 900,000 in a Roth. But um, it's very easy to see that 900,000 in a Roth is probably much better than $1 million in a pre-tax 401k, where you're going to pay taxes to get that money out. This is a very similar comparison here that just doesn't really tell the whole story. A lot of people look at this chart and say, why would I not want $26,000 more? And that's why there's kind of this untold built up liability in this that doesn't really get discussed, kind of gets glossed over. Another thing that you should understand is a lot of these numbers are going to assume really high tax rates to make the numbers more advantageous. And so you can see this chart from Freck. What they're assuming is a 42.3% tax rate that's getting factored into this. That would be the highest federal tax rate. And plus, some kind of surcharges that are out there too. And so one, just kind of understand that doesn't apply to a lot of people out there. If you're, millions of dollars in income, it might, but for the general, little bit more average client that we see, average investor out there, the differences here are drastically overstated because you're probably not in the highest federal tax bracket. And then a really big omission in a lot of the comparisons of direct indexing is assuming that a regular portfolio cannot tax loss harvest. And that's just not the case. If you have a brokerage account with a few ETFs in there and the market goes down, you're going to have the opportunity to tax loss harvest. It's not an all or nothing difference here. And so I have two charts here just to show you. This one on the bottom here is again from Freck, and it's saying that over 10 years with doing direct indexing, you can expect to tax loss harvest about 38% of the portfolio. And in some of their comparisons, like this chart we were just looking at, they're kind of saying in these scenarios, you don't do any tax loss harvesting, but even with just a basic ETF portfolio, you're going to be able to do some amount of tax loss harvesting. Again, it's going to depend on what the market does. In the average of some of their simulations here, they're saying even just a basic ETF portfolio could tax loss harvest about 20% of the value. And so here you can see doing a very basic index fund approach, you can still get about half of the tax loss harvesting available. You can still get some of this benefit without having to invest in thousands of individual stocks, pay some higher fees, and have that to worry about. Up in the top right is same type of data, but from a different company. Wealthfront is another direct indexing provider. And so there's just a column here of the percent of the portfolio that was able to be tax loss harvest with direct indexing, and then the other by a basic ETF portfolio. And again, what you can see here is that although you can get a little bit more in direct indexing, you can get a good amount with just a regular investment also. And again, that's just not factored in into a lot of the side-by-side comparisons. Another thing that kind of gets quickly kind of glossed over is that there are trading fees associated with this, and it is not commissions, so anymore, a lot of brokerage firms have $0 commissions. That's what makes this direct indexing actually possible. But $0 commission is not the same as saying you have free trades. And that's because every trade that's out there gets executed at what's called like a bid-ask spread. And that just means there is a little bit of a fee to any time you do a trade. It's small, but it gets multiplied when you trade a lot. And these direct indexing companies trade a lot. And so just to give you some kind of basis for how much trading is going on in these direct indexing accounts, again, this is from Freck showing some um, historic data here, and a $50,000 investment in their kind of given scenario here over I think it's 3 years and 11 months here trades a total of $468,000. And so you almost have like 10 times turnover in these investments, right? $50,000 gets traded over and over and over again, and each one of those trades adds some expenses there. There's some loss each time you have to do a trade. Just to put some numbers out there, I think Freck kind of estimates this to be somewhere around 2 basis points in costs. Vanguard in their simulations has this cost up to about 5 basis points is what they assume. And so that needs to get added in as you're thinking about the fees here, as you're doing some side-by-side comparisons like our example was. Besides just the fee you're paying to direct indexing, you're going to have an effective fee additionally of about 2 to 5 basis points out there. And then finally, I'll just say that getting out of direct indexing, if you go into it and then decide you don't want to deal with the thousands of individual stocks and hundreds of trades, it's very hard to get out of. Once you're in, you have that portfolio of stocks, and if you want to get out of it, you're going to be forced to do a lot of selling, potentially recognize a lot of capital gains just to get back into that ETF or mutual fund portfolio. And so it's one of those things that I think a little bit nerve-wracking to try because once you make that leap, it's going to be very difficult to get out. And so just keep in mind, spend an extra minute doing your due diligence here because once you make the leap, you're in. And so finally, just to, try to bring the other side of the story in here a little bit more is that there are scenarios when this can be useful. This was originally kind of brought out for very high net worth investors, very specialized scenarios. Now it's being sold as a way, I think quite honestly, just to get some higher fees out there. But there are scenarios when this could be considered and could be advantageous. And so I'm listing out some of these here. If you have a year with very, very high capital gains, much higher than you expect to be in future years. So maybe selling a very valuable vacation home, selling a business, something like that, and you have proceeds from those sales to be able to invest. Direct indexing might make sense where you can take advantage of some of those big tax loss harvests early on to offset what would be very high tax rate. Um, if you are envisioning making a very large charitable donation from cash that you have right now, I think there could be an argument for doing some of this direct indexing because you can effectively get those tax deductions early on and then just transfer this to the charity, maybe through a donor advised fund and let them deal with the 1,000 stocks and not have to worry about selling or something like that. Again, I think this is a pretty niche type of scenario. You'd have to have a lot of cash out there and then know that you want to donate in a few years or something like that. But I think the math would kind of say this could be advantageous. Um, if you have very concentrated stock holdings, this has some potential uses. Really only if you have a big holding in some of the very largest companies today. So think like NVIDIA, Amazon, Microsoft, something like that. And that gets into that customization benefit because you could, if you have $500,000 of NVIDIA stock and then have this other chunk of money you want to invest in the S&P 500. If you buy that S&P 500 index fund, a good chunk of that is going to go into NVIDIA because it's the largest company. And so direct indexing would allow you to pretty easily buy the other 499 stocks in the index, and you don't end up overweighting yourself with NVIDIA even more. And so again, this really only works for some of the top few big companies out there, but we are seeing this today just with NVIDIA employees that have a lot of company stock or something like that. And this, again, could be potentially a benefit for you. And then, of course, just to make sure it's out there, regardless with all of these scenarios, you have to be comfortable with doing this direct indexing for the long term. You have to be comfortable seeing the thousands of individual stocks out there for a very long time in your portfolio. And so, even if one of these top three scenarios apply to you, if you're not comfortable with the idea of this really being a long-term commitment, it might not be a good option for you. And so I hope that's helpful. No, try to run through a lot of numbers, couple examples, look over this at a high level. So hopefully it was helpful, but please let us know if you still have questions on this. If you've been pitched this and this didn't quite convince you, we can talk in a little bit more detail. If there are any questions, we'll be here to answer them for a little bit. Otherwise, thanks again and hope you have a good weekend.